On today's Hashi, I'm discussing consumer perception of home value, 9 long-term trends that will reshape the housing market, and President Trump's statements yesterday on the economy. How's that going to impact housing going forward? Today is Tuesday, March 11, 2025. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. Let me know in the live chat which market you are tuning in from. We do this show each and every morning, Monday through Thursday, when markets are open. Markets have been open for the last couple of weeks, as they always are. They haven't felt that good. We're going to talk about what President Trump thinks about how to think about the markets and stocks in the equity markets and all of that. But we do the show every single Monday through Thursday when markets are open, 9:30 on the East, 6:30 on the West. Best way to support everything we do at BAM is hitting the subscribe button right down below. Subscribe and notification. You get all of our other content for free here on YouTube, all of our other YouTube content and podcast content, including the Real Word podcast, which we'll have a new episode later today. I'll be digging more into the rocket acquisition of struggling Redfin. I'll be digging into more of that amongst other news topics, industry related, later on today. We were talking about that morning breaking news a little bit yesterday. I've got more to share. Tune into the Real Word podcast later today for that. All right. Let's get into this Fannie Mae consumer, these consumer findings, this consumer perception data from Fannie Mae. There's some, this is a full report. We're seeing a whole bunch of these consumer reports, consumer confidence reports. We looked at one yesterday as it relates to the home buyer perception, and home buyer perception was down a little bit month over month. And so we're now, congrats, Jason, on that deal. I love it. So we're now looking at even more of this information. Here's some of the key findings from this recent Fannie Mae report from consumers, and particularly about their perception of home value. Okay, so almost half of consumers right now, key findings from the report, then we'll dig in a little bit deeper. Half of consumers say their home has become more important to them over the past few years. So this is compared to just 10% who say their home has become less important to them. So the shift is driven by consumers' appreciation for the location of their home and the sense of security that it offers to them. So over time here, over the last couple of years, people are, I think really, I would even say that, this has become, since 2020, the importance of having the right space in the right location. When everything kind of changed in March of 2020, these conversations with buyers and home shoppers became everything. It's like, when your life goes and completely changes overnight, as everybody's did, it's like, wow, where do I want to live? Do I want to live with the shortest commute to work, or do I want to live around the people that I want to be around, or in the, climate that I want to be in, or in a particular town that I want to be in, whatever the case may be. A lot of it was driven, obviously, by a family decision. We always see that in real estate. People make decisions for their family, not just in real estate, but in all areas of life. People will do things for their family that they wouldn't even dream of doing for somebody else. So when it comes to where you want to spend your time, family's always been a big draw. And one of the findings here in this Fannie Mae report is that now more than ever, not identified particularly as family, but now more than ever, consumers say that their home, owning the home, where it is, and location being one of those reasons, is more important to them than ever. More than half of consumers also say that they have made fundamental changes to how they use their home in the last few years. Okay. So home gym for hobbies. I know in my community right here that I live in, there is a whole bunch of, a lot of us have like a 2-car garage and then a third garage, but the third garage is on the other side of the house. Like that's, you're facing 2-car garage. The third car garage is tucked into the other side of the house. So they're separate garages, if that makes any sense at all. A lot of people have put these gyms into that solo garage. And so I'm seeing a ton of people wanting to work out from home. I'm somebody who likes to get into the gym, but a lot of people really enjoy this. I would say it's a shocking number in here of how many people have done that. People are growing food, or maybe growing who knows what they're growing, or gardening and working from home. Working from home obviously went way up during the pandemic. Then there was this big call back to the office. And no matter what, when you look at pre-pandemic into the rest of history, there will be more people working from home, and we're never going to dip below whatever 2019 level was. I don't know what it was. I don't know if Haley, if you can pull a fact check on this. I don't know what the percentage was in 2019 off the top of my head, but I do know we're never going below that again on this work from home. There is a lot of benefits working from home. Haley's probably working from home right now. Actually, no, she's probably in the office because we have a Real Word podcast. I'm not sure. Haley, are you in the office? Are you working from home? A lot of times
I'm in the office.
Haley, do you want to share with the hot sheet audience your age?
I am 23.
23. So do you enjoy working from home more or in the office more? Which one do you like the most? If you could only pick one. I know how much you love coming into the office.
I don't know. It's a close call. I'd say working from home, but I do like being in office to give myself a break from just talking to myself all day at home.
Okay, so you like both. You like a hybrid work schedule.
Yes.
Okay. But if you could only pick one, if I said, Haley, you got to pick one, you can only be 5 days in the office or 5 days at home, which one would you go?
Working from home.
That was pretty quick. That was a pretty quick answer, right? And so I just think there's a lot of benefits to working at home. People enjoy it. It does take it takes a particular, if you have an employee, it takes a particular employee to be able to pull it off. Not everybody's made for it. You wouldn't want to, not maybe every line of work can even do it. Obviously, I mean, that's obvious. So it's not going to be for everybody, but there's certainly going to be more people working from home than less moving forward. Although more consumers still say the security and lifestyle benefits outweigh the financial benefits as the best reason to buy a home, this gap has closed significantly since we last asked the question back in 2015. So these are 10-year questions here that Fannie Mae is asking. That this is like, I mean, Fannie Mae operating for the long term. I mean, this is most people are doing this on a quarterly basis. All right. So here were the objectives on this research. Do consumers value their homes? And how are they using their homes? Is there a dollar value in consumers' minds for increased utility? Like, does that justify buying a larger house or a nicer house? Like, what's that dollar value for the increase in the utility that they can get out of the house? For me, in my house that I own right now in Naples, I did pay more to be able to have a full studio in-house. In Connecticut, I have an office that I go to. The team's in that office. I have a studio in that office. But here I wanted a substantial media room that would act as my office and my studio. And that was something that I was willing to pay more for in the right floor plan of the house, having a media room in the right area and all of that kind of stuff. That was important to me. So I guess for me, I would answer yes. I'm curious in the chat how you would think about that for your own home and how your consumers are thinking about it. Could this be contributing to higher demand and prices, particularly for certain types of homes? Okay, so those were the objectives here on this research. They vetted out approximately 1,000 American adults, 18 and over, of course. The survey was fielded through Amerispeak, NORC, at the University of Chicago, probability-based panel. This is in coordination with Fannie Mae and PSB Insights. So a lot of sounds like a lot of really smart people were involved. All right, let's get into some more of these findings. Okay. More than 2 in 5 consumers say their home has grown more important to them in recent years. That was part of the key takeaway. Some pretty interesting infographics. Those will be available for you inside of BAMX. Of course, school.com/BAMX. If you're not part of the community yet, jump in there. You get access to all of my notes from this show, as well as all of the graphics that we carve out for you. So it's right at your fingertips. 44% say home is more important to them versus 10%. Only 10% is saying, hey, it's less important. And home being classified as where you live. So owners, that number is 48%. Renters, it's 38%. Less important. Only 6% of owners say that is the case for them, while 17% of renters are saying reasons why their home has been more important. Again, that's location and the sense of security. Okay. So when you love your home's location, it's hard to give it up. When I moved into this home, my last home here in Naples, I loved the location. I absolutely loved it. It was perfect for me. Okay. It was you had 2 exits out of the community, all the shop, everything I needed. Now I'm only, truth be told, I'm only like 7.5, 8 minutes, something like that, up the road. But it's an 8-minute difference from the best location that I thought to like still a great, phenomenal location, just 8 minutes, 10 minutes out, depending on traffic, 10 minutes this time of year, outside of exactly where I would prefer to be. And it is hard giving up perfect location. When you get used to perfect location, my Connecticut home, I feel like, is in perfect location. I would sell that house every single day of the week if it wasn't for the location. The house is great, but I'm like, man, I've got equity. Like I've done well. I like to buy and sell every couple of years. Classic real estate agent, right? I like to move it, once I've owned it for a little bit and I've gotten that value out of it. At this point, I've gotten the value out of it, but the location is so good. I can walk to everything, restaurants, all of that kind of stuff. So location is hard to give up once you get spoiled with it. When you get spoiled with great location, you're willing to give up on things that might, benefit you floor plan wise. Location is a strong pull. I learned this very early on in real estate. First house I bought at 19 years old, a 2-family, 21 something years ago, was in an awful location, just a terrible location. And it took, I still don't know if to today it's back to the value I paid for it, because the location's done nothing but get worse. But I bought something that had the floor plan of what I wanted for a 2-unit building. I'm like, wow, this is perfect to, for me to fix up 2 apartments. The floor plan makes sense. The layout makes sense. The bedroom count it all made sense from an apartment standpoint, but from a location appreciation standpoint, it made absolutely no sense. And I certainly wasn't just rolling in the cash flow when you did the math at the end of the year. So you learn a lot about location when you make a location mistake. Functional changes to the home. Again, 25% say they work remotely from their home. So that's 1 out of 4 right now. I don't know if, so Haley did have that stat. Why don't you post that? In 2019, approximately 5.7 primarily worked from the home. And according to this, now we're at 25%. So big difference there. That number's not going down below 5.7%. Back in 2019, it'll never drop below that or even to that. I don't think single digits is even within question ever again. And 55% say they made functional changes to their home to basically adapt to their lifestyle. So, like that gym in the garage, or, taking a media room, which everybody else has, as a movie room and making it office and, in-home studio. Consumers are willing to pay more for these features. Okay. So, when you're taking a listing, when you're educating a seller, these are things to consider if you have an aspirational seller, somebody who wants to reach for the stars on price. These are the things that might get you closer to the stars, might get you closer to a bidding war, or somebody willing to pay a little bit more, or finding that right buyer. It's outdoor living spaces. Beautiful outdoor living spaces are intoxicating. I love when you see like the bluestone patios with the fake turf between each, like the big bluestone tiles and the fake turf between each one. That is that to me, it's just a beautiful setting. I don't know if you agree with that or not, but just beautiful outdoor settings where they've spent time on the details in the landscaping and manicuring and keeping it clean and keeping it nice, keeping it functional, having a perfect place to smoke a premium rolled cigar or enjoy the sunset or sit by the pool or have a view or have the peace and quiet or have seclusion, or a properly, nice fenced in area for your pets or for whatever. Like those things become what pulls on your buyer's emotions. Those are the things that can just latch into the memory when you see a property where it's like, I could see myself sitting there, 4 p.m. On a Friday afternoon, winding up the week. I'm planning for my weekend. I'm planning for my week ahead. Maybe I'm just writing or listening to some audio, and I'm thinking. And for me, having a beautiful premium rolled cigar, and you're just kind of enjoying that space, having that area to relax and really plan ahead or unwind. Outdoor living spaces, 61% say, hey, I'll pay more for an outdoor living space that is perfect and I don't have to do anything to it. Extra room for hobbies, gym. The gym thing is growing right now. It's why you're seeing like there's some gyms that really have to elevate the experience. I saw something recently on all these like bougie fancy gyms that have just taken the experience up, 10x, where like just the purple and yellow equipment gyms, I forget what the name of those are, but they're not what attracts people into retention. The churn is high. Churn is going to be high at a gym anyway. But it's got to be more experiential to get people to say, hey, I'll just buy something at my house. Whether they use it at their house or not, anyways, is not the point. It's like having the membership. It's there if I ever get motivated type of thing. Walkability to community areas, 47%. I would have thought that would have been higher. I think Planet Fitness, there you go. I think once if you've never lived in what you consider a perfect location with walkability, like perfect, ideal, then it's hard to say that, you'd pay more for it. Like once you experience it, it's like, you just got to have it. I know there's some boycott going on Teslas right now. Or at least I'm hearing about that. I guess Trump's going to go buy a Tesla to support his buddy Elon. I can tell you, like, before I bought a Tesla, I was like, I don't know. I don't really care because I don't care about cars. Once I experienced an electric car, never having to stop at the gas station ever again, being able to just charge at my house, like not having to worry about oil changes, that the ease of maintenance, the functionality, the way the car updates itself every month, like it's your cell phone, the ease of driving, like the fact that it goes faster than like all the guys who are revving up their engines and they've spent so much time in their garage, like fixing up their car and caring about the speed of their car. And like the fact that when I learned the Tesla goes faster than that, I was like, wow, that's just like another perk. But really just the ease of the maintenance, never getting gas, never getting oil. It's like, I'm never going back. I'm never not going to have an electric car. I'm never not going to probably have a Tesla because I'm now have been spoiled with that luxury. But like once you get spoiled with walkability to community areas, it's hard to give it up. So I'm surprised that's not a little bit higher. And then the yard for gardening and growing, that's becoming, with the food thing, that's becoming a huge deal for a lot of people. Financial benefits of home ownership, such as value as an investment. Okay, interesting. So 39% were, this was a reason to buy a house back in 2015. 46% of buyers today are looking at the financial benefits. Okay, that might be a stat, something you use in some type of communication or marketing, or like, hey, there are more buyers today looking at this from a financial benefit standpoint than there was 10 years ago. Okay. People are looking for stability. Look what's happening in the markets right now. People are looking for stability, security of and lifestyle benefits, actually less. Okay. 57 in 10 years ago, down to 52%. The broader security and lifestyle benefits of home ownership, a secure place for your family, and being able to control renovations and all of that. Not a lot less, but slightly down, where the investment part of it is actually up. Now, look at the time. Obviously, this was taken in Q3 of 2024, where it's, that's a tough time. That's a tough economy, all of that. So could that influence that number a little bit? Certainly could. All right. Here we go. I mean, there's a whole bunch more actually in this. Let me just see if there's anything else I missed that I wanted to hit. This is the full list. We talked about location and sense of security being the top two. Entertainment, leisure time spent at home, customized home, access to outdoor living. Those would be the next ones. There's more information here. You can dig in. I'll leave the rest of this to you if you're interested in it. And if you're interested in just taking some of the quick, the quick infographics that we have, just jump into the classroom on BAMX in the community, go to the hot sheet tab, and we've got that all outlined here for you, along with everything else from today. That's school.com/BAMX to grab all of that information and obviously get access to that full report. That report's 66 pages, a ton of data in there. We'll probably use some of that for the done for you content on Friday. That'll be inside of BAMX as well. All right. There's 9 long-term trends that are going to reshape the housing market. Okay. So what are those trends? Resi Club and my buddy over there, Lance Lambert, did a good job of breaking these down for us. All right. So number 1, household sizes are shrinking. Okay. The breakdown of the U.S. Household back in 1960. Look how many more 7+ people household there were than today. There's barely any today. Think about how many, people have more than 3 kids, and it's really just like one generation later, right? My dad's from a broken family of, I think it's 7 or 8 kids, but between the two sides. My mom was 10 of 10 kids. And so like whatever, my dad's 7, 8, 10 on my mom's side. Yeah. A lot of cousins out there. But that's like, you don't hear of that at all. Just one generation later, I've got 2 kids. Okay. So one generation later, not even a considerate, like we couldn't even hang in there to go for 3, like we're done. 2, we got 2. And that's it. Right. So, people are definitely having, less children. And look at this, 1 person household, is on a very big rise from 1960 to today. And I mean, even the last 10 years, that number continues to go up where you've got 1 person household, 2 people household, 3. So very small households, which, there's 2 sides of the argument here, right? It's, like does a 1 and 2 person household value home ownership? Or are they going to be, renting, more likely to rent? Or does this mean, there's just going to be more when you've got smaller households. There's going to be more people looking for inventory, and the percentage of households with one person, two people, all the way up to 7. That data was taken from the U.S. Census Bureau. So just looking at where that data came from, U.S. Census Bureau, delayed life events. So younger generations are postponing things like school completion, marriage, homeownership, you know the deal. And that's obviously one of those reasons. But then falling birth rates is another one. As you look decades forward, the falling birth rates will have, a greater impact on the U.S. economy stronghold, as well as, potentially, home values to go decades forward in the next 10, maybe 15 years. It's like, are we going to need more or less houses? The general rule of thumb here is we're going to need more, that we're short to meet demand. Number 2 is decelerated domestic population growth. The U.S. Census Bureau continues to downgrade its U.S. population forecast. So here's, again, this will have a bigger impact on U.S. economy overall. It's one of the reasons why, while the administration ran on deportation of illegals, at the same time, they're saying, oh, we want to sell $5 million gold cards. Because if you don't have immigration coming into the country with this population forecast, that's going to mean long-term trouble. You get into the 80s and the 90s. Boy, going back to the 90s. I hope I make it for my second run in the 90s. Probably low chance of that happening. But in the 90s, in the 80s, second run at the 80s and 90s. Who's with me for that? Who wants to get back to the 80s and 90s? That would be the real golden era of America. But we're seeing a decline there. That's going to be trouble for America if they want to keep that economic foothold, that power position. Here are the stats, right? In 2008, the U.S. Census Bureau forecasted the U.S. population to reach 439 million in 2050. That goes to 400 million. Or in 2012, that number dropped to 400 million for 2050. In 2017, that number dropped to 389. And then in 2023, that number dropped to 361. So that, as they update that number, it continues to drop from 439 million as a projection for 2050 back in 08. In 2023, now to 361. So 80 fewer million Americans. And that would be a 2050 housing market that has 80 fewer people than originally projected to buy homes, own homes, invest in homes, rent homes, all of that. Okay. This is one of those drivers here, is fertility rates are declining across the world. RFK Jr. may have an answer for why that is. I don't know. I think it's just, it's just not common, especially as you live in in the Western world and countries that are, like America or Canada. It's just not common for people to have a ton of kids either. I think fertility rates certainly probably are down. Not an expert in that, but people just are changing the way they live in that sense of the decision of, do I have more or less kids? I mean, I can't even, my grandmother had 10 kids. I don't know what was she thinking. I mean, when she had 10 kids, I'm sure 6 through 10, my mom being 10, were probably all mistakes, but they went for 10. That's just crazy. Home builders are going smaller. So here's another trend that we've seen for not just the last couple of years with affordability, but for 10 years. Homes from 2013 to 2023 have consistently trended going smaller as costs to build these homes continuing to go up. Okay. Trend number 5, median home age by U.S. county. So you're seeing that the median home age in the South, interesting. In the Southeast, obviously much younger, where the construction is happening. Out West, it's a younger home. Look at the Northeast. Median home age is up in the 70s, the 60s. You see that in parts of the Midwest as well. I mean, in Florida, I don't, any Florida agents disagree with me. Like anytime someone's asking me about buying a house in Florida, I'm like, don't buy before the year 2000. I don't know if you disagree with it. Florida agents don't shoot the messenger on that one, but I'm just like, well, why would you buy it? There's so many homes built after the year 2000 with, better, construction for, protection against hurricanes, standards for hurricanes and whatnot, that why would you ever buy a house before 2000? I just don't understand why you would do that, unless you just have some perfect location like we were talking about before. But generally speaking, why would you do that? I mean, when you go to the Northeast, try finding a home before the year 2000 available on the market. It's like, where's Waldo? Okay. So homes are getting older. The inventory is aging. Additional supply and sales are created by aging boomers. Okay. So the annual decline in the number of baby boomers, U.S. homeowner household. This is as estimated by Freddie Mac. This one's interesting because it's projecting out in the future. Okay. We're going to have 400,000 less number of baby boomer U.S. homeowner households this year. That's the largest decrease in a year. We had 300,000 last year. It goes up to 500,000 next year, then 600,000 less in 2027. So there's a compounding effect on this, then 600,000 decline in 2028. You get to 2033, okay, just 8 years. You're going to lose 1 million in that year. You're going to lose 1 million in 2034. You'll lose 1.2 in 2035. Excuse me. So boomers being the generation from 46 to 64, the projection from Freddie Mac, boomers, don't get mad at me, get mad at Freddie Mac saying, hey, the decline on the number of U.S. homeowner households is going to start to accelerate. Okay. Where are those homes going to go? Are they going to go to the kid? Are they going to go to the millennial kid? Or are they going to go to the market, right? Is this going to be one of the, is the way we're going to pad inventory of some of these boomer homes coming onto the market? Number 7 is the big trend shaping it is obviously home insurance risk. And so we know that there's been huge shocks to places like Louisiana and Florida and North Carolina and Tennessee and California. And, we've seen so much, climate catastrophes in those 5 locations in particular, and insurance is going to go up, not just there, but everywhere. We've heard Jerome Powell speak about this. Both banks and insurance companies are pulling out of coastal areas or areas where there are a lot of fires. So insurance is just going to get, expensive. And, that's going to be one of those things. Dave Ramsey always talks about fixed cost of home ownership. And, your debt is, has a 30-year plan on it when you have fixed interest. But the insurance is going up at a rate where it is definitely a concern on whether people are going to be able to continue to afford that. Okay. Here's just the 3-year change in median annual home insurance premiums by county. And those areas with the darker blue have gone up by as much as 60%. Look at Florida. All of it is in that dark or almost dark blue. Louisiana, same thing. And you're about to see that, state of California get darker blue. You're probably going to see it in North Carolina and really just the rest of the country as they spread that risk out amongst all homeowner insured homeowners. Okay. Home insurance non-renewal rates by county. I mean, look at the Northern California areas there and Florida areas and some of those Eastern Seaboard areas where you just have non-renewal rates that are going up for sure. Projected growth in the average home insurance premium from county. This is 2025 to 2055. Okay. You're seeing Duval County, that's Jacksonville, 333%. Miami-Dade expected to go up 590%. New Orleans is expected to go up 634%. El Dorado County in California is projected to go up 291%. Those are just some of the ones that stand out. Built to rent matters as an asset class is trend number 5. JP Morgan Asset Management, believes in this. They're teaming up with Georgia Capital and Parent Homes to establish BTR Company. We know how much JP Morgan, we talked about this on a recent hot sheet, believes in investing in real estate here for the long term, and build to rent is not going away. That's a trend that's going to continue to reshape the housing market. Here's 50 metro area with the largest single family build to rent pipeline: Florida, Texas. So the areas where they're building: Carolinas, Georgia. You're not seeing it in the Northeast, as you predominantly don't see much building there in comparison to other. Look at Phoenix, 13,000 units. So really where you've seen the migration trends happening is where this is happening. You have a sprinkling in other parts of the country, but it's the Sun Belt states where a lot of the building has taken place, which is going to continue to increase inventory and is going to continue to put pressure on the for sale inventory as we've seen in those locations as well. Share of U.S. Single family housing starts being built for rent. It's right now at its highest that it's been in 20 years, 9.5%. This is back in 2023. So over the last 20 years, recently we've seen that number the highest it's been. Big builders keep getting bigger. This is a trend on everything, by the way. Big companies keep getting bigger. If you didn't see that with, Rocket yesterday, like Rocket is, they've got access to capital. They were able to, write this check. Well, they're doing it in stock actually, so not writing a check, but they were able to give up $1.75 billion in stock to Redfin, to acquire that company, which was once valued at a market cap company at 10 billion, how they have fallen. But big builders keep getting bigger. They've got economies of scale, so they're able to, get cheaper labor across the board. They're able to get cheaper materials. The economies of scale work for builders. Where you have a smaller builder in a local community, it's gonna cost more. They just don't have the leverage that a big builder has. And we're gonna, like I said, we're gonna continue to see that with all companies. Rocket is the number 2, lender in the country right now. UWM has taken over United Wholesale Mortgage, the number 1 spot. Rocket obviously wants to get that 1 spot back, but the gap from 1 and 2 and everybody else, it's huge. And so the gap right now between, publicly traded builders and everybody else is getting significant. Just look at right now, 53% market share right now versus, about 20 years ago, it was only 25%. They've more than doubled market share. U.S. home builders, publicly traded home builders. It's prohibitive for a local builder to just build a regular house. They got to go luxury. The best builders in most local markets, let me know if you agree with this in the comments. The best builders have gone luxury because they're like, it just doesn't make sense for me not to go luxury. I work too hard to not go, luxury. It's too prohibitive for a builder to, take the risk and, build a regular home for such a short margin when there's luxury buyers out there. Here are the 50 largest, if you're interested, mortgage originators of 2023 by total dollar loan volume. I don't know that 24 numbers are out. This is just a recent tweet by Resi, but look at the top 2, how far and ahead they are of everybody else. 76.3 billion is Rocket at number 2. United Wholesale's over 102 billion. Number 3 is at 29. JP Morgan. Cross Country's at 27 billion. Bank of America's at 27 billion. Fairway's at 26. Wells, which I thought Wells was out of this, they're at 24. Loan Depot. I mean, they've got their name on a stadium and they're at 20 billion. Okay. Rocket and United Wholesale own stadiums. Their owners own teams. Cleveland Cavaliers, Phoenix Suns, other teams like United Wholesale and Rocket. They own teams. They own stadiums. Loan Depot has their name on one. That's the difference in these mortgage companies right now. All right. Also happening right now is a lot of comments from the new 47th president, Trump. Okay. Trump says a transition period for the economy right now is likely. So trying to kind of take the sting out of what, equity shareholder, people following the stock market. If you follow it every single day, you haven't had many good days the last few weeks. Trying to take that sting out and prep possibly for more L's. Okay. You can't really watch the stock market, Trump is saying. I remember in his first term, he was touting the stock market, but now saying you can't really watch the stock market with some of the dramatic changes that have been happening in term 2 versus what was taking place in term 1. So there are fears that are brewing over the tariffs, the jobs. Trump and his top team are acknowledging there could be some short-term pain for the economy before the market and the markets before it gets better. So saying, hey, there's going to be, when you make this type of radical change, there's going to be a transition period, a step back before 2 steps forward. That's what the administration is touting. What I have to do is build a strong economy, the president said. You can't really watch the stock market, which is a shift from how he would talk about the stock market, certainly in term 1, 4 plus, 5 plus, going back 8 years, certainly 8 years ago when he started term 1. He talked about the stock market, it seemed like quite a bit. An emerging theme from the administration is that any slowdown or reversal in growth is a legacy from, obviously the president before is going to get the majority of the blame when things aren't going right economically in the beginning. And listen, like just being fair, yeah, I mean, he could be right. There's a step back and then an acceleration. Now, also to be fair, there's people that are saying, no, like we're heading for that recession word. Like we saw that yesterday. We're seeing it again here in Mark Zandi's recent comments. Okay. So I'll open up a recent tweet here from Mark Zandi, Moody's analyst here. Mark Zandi says the recession of a U.S. Or the risks of a U.S. recession starting in the coming year are uncomfortably high and rising. He would put them at a 35% up from 15% at the beginning of the year. So Mark Zandi saying, hey, we're up 20% on how he would view chances of a recession. He's not over 50%, but 1 out of 3 chance right now from Zandi at Moody's that we're heading into a recession. He says the tariffs are going to spark a global war. Now, tariffs are like a light switch. I can say I'm going to implement them one day and take them down the next day. It's not like, it's not like going through a permitting process to build a waterfront dock where you spend, 2 years trying to get the permit. And once the dock is in, man, that unless a storm comes and knocks it down, that thing is going nowhere ever. I'm leaving that dock in. It's too valuable. It's too hard to get. And that dock is going nowhere. Okay. So it's more like a light switch. Like, I'll say a tariff one day, I'll change my mind the next day. And we've already seen a little bit of that. Mark Zandi saying that these tariffs will spark global trade war with U.S. trading partners imposing their own tariffs back and forth. He says stock prices will also continue to slide, weighing in on the wealth and spending of well-to-do Americans, which drives much of the economy's current growth. Now, that's one point of view. To be completely fair here, there are other points of view. Okay, if you look at Kathy Wood, who is, somebody who is, she's on every economic show. She's, she runs ARK Invest. She's a big investor and she has a completely total different view. In our view, the market is discounting the last leg of a rolling recession, which will give the Trump administration and the Powell and the Powell Fed many more degrees of freedom than investors expect. And she says that this actually, what we're seeing right now, sets the U.S. economy up for a deflationary boom. We're going to get CPI tomorrow, I believe. So we'll get some real-time data on inflation this week. But a deflationary boom in the second half of this year. Okay, markets are at a turning point. Tax cuts, tariffs, shifting monetary policy. Where are things heading? This is where she thinks they're heading. So she's got a, certainly a glass half full or all the way full with good vibes, saying boom time second half of the year. I mean, that would sound, if she's right, that sounds like a perfect little scenario for me. Like a lot of the fears right now have been driving this number down, this, 10-year treasury number down, certainly to the low point in the last 3 months, 4.221 here to start the day. We know what that means for housing. It's brought our 30-year fixed into a more reasonable number for, the mental barrier for a lot of home shoppers. This number dipped here at the beginning of the week from where we ended last week at 6.72. So like if Kathy Wood's right, maybe some of these fears, people moving out of equities into long-term here, investors moving into long-term, it pushes the 10-year yield down, pushes 30-year, a little tailwind for the spring market, and then a deflationary boom second half. Hey, I would take that. So I guess here's to hoping that Kathy Wood is right on that prediction. Here's a prediction that you can almost, bet the life savings on. 97% CME Group says there will be no Fed cut next week. So that flexibility for the Fed that Kathy Wood is talking about, not likely to come next week when the FOMC meets. All right, there you go. There's your hot sheet here for this week. To get more out of what we do at BAM, obviously subscribe to this channel. That's absolutely free. It's the best way to support us for free. But to get more out of what we do, get access to all of the hot sheet show notes each and every single day that we do the hot sheet, as well as all of our all of the slides from the show. Just jump into BAMX over on School. It's the #1 community and platform. We have 30 plus on-demand courses, as well as done for you content each and every single week, all uploaded into BAMX. Go to school.com/BAMX to grow, to join the fastest growing community in real estate, the community that actually has your back, keeps this business fun, and sifts through the BS for you. School.com/BAMX. Link down below. I'll see you guys in there. I'll see you later on today, later on the channel for a Real Word podcast, where I'll get a little bit deeper on the breakdown of the Redfin sale to Rocket. All right, more later on today. And of course, tomorrow we'll be back with another hot sheet, 9:30 on the East, 6:30 on the West. Until then, toodaloo.